All right, let's jump right into this explainer and tackle a topic that is absolutely crucial, yet honestly pretty frequently misunderstood inside the SAP S/4HANA Universal Journal. We're talking about document splitting. We'll be breaking down the entry view versus the general ledger view. If you're working in SAP, whether you're a consultant, an accountant, maybe a financial analyst, getting a firm grip on this concept is literally mandatory if you want to master parallel ledger reporting. So before we get to the solution, we really need to understand the pain point. Why do your profit center balance sheets never seem to balance? I mean, if you've ever tried to pull a legally compliant balance sheet for a specific profit center, you know the absolute frustration of the books just simply not tying out. You're sitting there, staring at your screen, wondering why on earth your assets and liabilities for one specific segment just refuse to align. And this setup right here brilliantly illustrates exactly why that happens. In traditional accounting systems, your operational lines, your everyday expenses and revenues, they are super easily and neatly assigned to internal management entities, like a profit center. You know exactly which department bought what. But then look at the right side. Your cash, your vendor payables, your tax line items. When you're entering the data, you can't really assign a profit center to those manually. So what happens? They just end up sitting in this giant, messy, completely unassigned pool. To see how SAP actually steps in and solves this abstract problem, let's ground this in a quick, real-world micro case study. We're going to look at a super simple, everyday transaction and €11,000 total liability for a vendor invoice. Keep this number in mind because it's going to be our anchor throughout this whole explainer. Now, here is the real game changer. To tackle this reporting headache, SAP S/4HANA essentially maintains two completely distinct views of the exact same accounting document. On one side, you have the entry view, which is exactly what the user sees and types into the system. This is where the problem lives. And on the other side, you have the general ledger view, which is what SAP processes in the backend. That's the solution. Let's start by looking at the entry view, which happens at the data entry level, typically using a transaction like FB60. Okay, so here is our €11,000 invoice broken down exactly as a user would enter it. Notice the total credit to the vendor account is 11,000. That's made up of a €10,000 total expense, which we are splitting between two different departments. 8,000 goes to expense 1 and 2,000 goes to expense 2. And finally, rounding it out, we have a €1,000 input tax line, representing a standard 10% tax rate. Simple enough, right? But check out the Profit Center column on the far right. This is where things get sticky. Our expenses are neatly assigned. The 8,000 debit clearly belongs to Profit Center X, and the 2,000 debit belongs to Profit Center Y. However, the vendor payable line and the input tax line, they are glaringly empty. And it makes sense, right? Because frankly, it wouldn't make any accounting sense for a user to try and manually carve up a single vendor balance across multiple profit centers during data entry. So that leaves us asking, how much of the tax and vendor payable actually belongs to Profit Center X? If you run a report for PCX right now based strictly on this entry view, you've got a major problem on your hands. You clearly see the €8,000 expense, but you have absolute zero visibility into its share of the total liability or the taxes. Your balance sheet is fundamentally incomplete. So let's go behind the scenes and see exactly how SAP calculates the split to fix this. The system automatically looks at the driving lines of the document. In our case, those are the expenses. Step 1, it identifies that the total base expense is €10,000. Then, it just does the math. Profit Center X is responsible for 8,000 out of that 10,000, giving us a clean 80% share. Profit Center Y takes the remaining 2,000, giving us a 20% share. Now watch how this builds. SAP takes that 80-20 expense ratio and automatically applies it to those unassigned vendor and tax lines. It splits the €11,000 vendor liability into a 8,800 portion for PCX and a 2,200 portion for PCY. And it does the exact same thing for the €1,000 tax line, 800 to X and 200 to Y. And the best part? Zero manual calculation required from the user. Which brings us to the general ledger view. Looking at the data after document splitting has happened in the ACDOCA table. I mean, just look at this transformation. If you compare this to the entry view we saw earlier, it's night and day. The one's empty profit center fields for our vendor payables and our input taxes are now fully populated. Behind the scenes, SAP has dynamically generated new line items that inherit that 80-20 split, making sure every single dollar is accounted for by a specific profit center. The end result is pure accounting magic. Not only do the total debits and credits equal out for the company as a whole, but they also balance perfectly within each individual management entity. Profit Center X has exactly 8,800 in debits and 8,800 in credits, and Profit Center Y has 2,200 in debits and 2,200 in credits. Perfect symmetry. So what you should really take away from this is a crystal clear understanding of SAP document splitting. Think of it as the automated engine that ensures your financial reporting characteristics, like a profit center or a segment, dynamically flow from your operational P&L lines straight to your balance sheet lines. By doing this, it completely eliminates manual reconciliation. It gives you zero balance segment reporting instantly right out of the box. Now, we've successfully fixed the initial invoice using what's known as active splitting. But of course, solving one problem always opens the door to another, right? It begs a fascinating question. What safeguards handle complex internal cross-department transfers that simply don't balance naturally to zero? And maybe even more importantly, how does the system remember these exact 80-20 splits when you finally make the cash payment to this vendor weeks down the line? Well, answering that requires diving into passive splitting and zero balance splitting, which is exactly what you should explore next to truly master the Universal Journal. Until then, keep analyzing and keep learning.